Welcome to Running a Small Business, Part 3, Corporate-Owned Life Insurance and Personal Estates. There are many sound reasons for corporations to use life insurance to support their operations, objectives, and the needs of key individuals and shareholders. Corporations may provide benefits or be perceived as providing benefits on a favored basis to shareholders, key employees, and their families. This may trigger unanticipated legal and tax consequences. A corporation's need for life insurance may change or even disappear. The owner may develop different priorities. The coverage may be needed by the person insured for individual tax and estate planning. Estate claims may attempt to include corporately owned insurance policies. So what's relevant? Tax policy has changed much in the last few years, impacting long-time strategies. This session takes a deeper look at individual policies owned and or paid for by the company at the time of purchase and the legal and tax implications of transferring policies or flowing benefits to family members for personal estate planning purposes. As always, this presentation reflects the views of Empire Life as of the date presented. The information in this presentation is for general information purposes only and is not construed as providing legal, tax, financial, or professional advice. The Empire Life Insurance Company, of course, then assumes no responsibility for any reliance made on or misuse or omissions of the information contained in this presentation. Please seek professional advice before making any decision. The general approach for corporate-owned life insurance is for the corporation to be both the owner and beneficiary of the policy. This applies even if we are considering a holding company and an operating company. The company that pays the premiums should own the policy and be its beneficiary in order to minimize the adverse tax consequences that can crop up. A common question is whether the premiums on corporate-owned life insurance are a deductible expense. An inappropriate structure of a life insurance policy to support a strategy may trigger taxable employee or shareholder benefits. The strategy itself may trigger a similar result. The premiums may or may not be deductible. Funding a group life insurance policy is deductible to the company paying the premium and is a taxable benefit to the employee under subsection 6.4 of the Income Tax Act of Canada. It's reported annually on a T4 tax slip. The same holds true for any funding provided by the company for individual life insurance policies issued typically to key employees and executives. The strategy involves either carving out key employees from the group plan or offering additional top-up coverage. Plans can be customized for each individual, providing an opportunity to purchase permanent coverage, which may also have cash values. Each individual can fund the plan with personal dollars over and above a company contribution comparable to the allocation for group coverage. Let's take a deeper look at individual policies owned and or paid for by the company at the time of purchase. Let's focus on the scenario where the borrower is both owner and beneficiary of a life insurance policy. But of course, before I do that, let's talk about more basic situations where a corporation could be the owner and beneficiary, which would apply in situations where the premiums are for key person coverage, which of course are non-deductible. When you're looking at a situation of a share purchase agreement and funding that with life insurance, the premiums, of course, for that are non-deductible. And when you're looking at a policy where the corporation is both the owner and the beneficiary, and the premiums are designed for a charitable gift, the premiums may be deductible when the charity becomes the owner as a deduction, and the cash value may be deductible on the transfer as a deduction under paragraph 110.11a of the Income Tax Act of Canada. Let me go back then to the whole idea of collateral coverage and when that may be deductible. Premiums for collateral coverage may be deductible if they involve a restricted financial institution under subsection 248.1 of the Income Tax Act of Canada. And that's really going to be the focus for the next few minutes. The borrower is both the owner and beneficiary of a life insurance policy. When you're looking at a situation like that, a portion of that may be deductible. And it may be deductible under paragraph 21E2 of the Income Tax Act of Canada. And we're assuming we're not talking about a leveraged insured annuity or a 10(8) scheme. The premiums need only be payable versus actually paid as long as premiums are actually paid. Here's what I mean by that. A stipulated or contractual premium under a permanent participating life insurance policy funded by dividends are okay. And that was covered off in a technical bulletin issued in September of 1992. there may not be stipulated contractual premiums under a universal life policy. So funding the premiums of that policy via the accumulation account or a side account would not qualify, and that was covered off under technical bulletins that was issued in 1999. It was also covered under question 3 in the 2007 APFF conference, and again is covered under another document that was published on October 5th, 2007, dealing with universal life policies and funding the premiums of that with a side account or the accumulation account. The policyholder in those situations may elect to pay an equivalent amount of money, equivalent to the net cost of pure insurance for a given year, to gain potential deduction on a collateral assignment. Now, the net cost of pure insurance of the policy for the year is prorated for the policy taxation year when it's not aligned with the corporate tax year end, and that's bound to happen. And it's covered and defined under Regulation 308 of the Income Tax Act of Canada. What can be deducted? Again, a portion of that may be deductible. It is the lesser of the premiums payable by the taxpayer under the policy in the year and the net cost of pure insurance of the policy for that year. So we may be looking at a prorated amount for life insurance premiums when the policy year straddles the taxation year of the company. That can be reasonably attributed to the amount owing from time to time in that year. So there's a further prorating that can actually occur. Now, two differences are noteworthy between the treatment of pre- versus post-2017 policies. Pre-2017 policies have a higher net cost of pure insurance, and those calculations do not include ratings. Post-2017 policies have a lower net cost of pure insurance, but they do include ratings. For policies issued before December 2nd, 1982, the net cost of pure insurance is not subtracted from the adjusted cost basis of the policy. So when you're looking at collateral assignments, take a good hard look at whether these policies are pre-1982 or certainly December 2nd, 1982, whether they are pre or post-2017. But whatever the calculation, it doesn't stop there. The portion of the premium or net cost of pure insurance that may be deducted needs to match the loan amount outstanding. So let me give you an example. If the policy sum insured is $200,000 and the policy has a cash value of $50,000 and the amount owing is $100,000, well, what happens? Okay, so we've got a policy sum insured of $200,000 that has a cash value of $50,000. That means that the net cost of pure insurance is based on the net amount of risk, which in this situation would be $200,000 minus $50,000, which is the cash value, or $150,000. It is not the net cost of pure insurance on the entire $200,000. Now, the percentage that's available for deduction is half of the sum insured, which is 50% of that net cost of insurance, pure insurance. Now, where did I come up with that half of the $200,000? Let me repeat the scenario. The policy sum insured is $200,000. The cash value is $50,000, so the net amount of risk is going to be based on the difference of that, which is $150,000. And keep in mind, of course, at the time we're trying to make that deduction, the amount that's still outstanding is $100,000, which is half the sum insured. So half the sum insured is 50% of $200,000, which is 50% of the net cost of pure insurance. The cash surrender value plays no further factor. And one last note, an unused line of credit doesn't qualify as an amount owing regardless of the associated fees for having it. When a shareholder borrows money and wishes to use a corporate asset as collateral, there will be a deemed taxable benefit for the difference between what the shareholder is able to get in terms of amount and terms using the asset or not using that asset. In the previous example, the assumption was that the borrower and the person seeking deduction is one and the same person. They're the owner, they're the borrower, and they're applying for the money. But what happens when a shareholder borrows money and wants to use the corporate asset as collateral? Now, that may include life insurance coverage to secure the loan. And so a shareholder that's seeking out a personal loan goes to a restricted financial institution. The restricted financial institution has certain terms and conditions. They're perhaps asking for collateral, and one of the pieces of collateral that perhaps they're looking for is life insurance coverage. And rather than use personal coverage, or if there's insufficient personal coverage, the shareholder may say, well, let me pledge that corporate asset. There's a taxable benefit that occurs at that point in time that may be offset by any consideration paid by the shareholder to the company for that benefit, for the privilege of being able to use that life insurance policy as collateral. Usually that benefit, that taxable benefit in the offset can usually be structured as a commercially and competitive set guarantor's fee. Even when this is done, there is another consideration. Should the policy proceeds be required to retire the debt on the passing of the shareholder? In other words, there is still a debt outstanding, a loan amount outstanding when the shareholder dies. The shareholder whose life is insured passes away, and the life insurance now owned by the corporation is going to be paid out by the insurance company. And what we want to be able to avoid here is that as a taxable benefit at the time of the payout. What can happen? If the proceeds are paid directly to the lender, then in actual fact, the company has retired the debt, and that's going to trigger a taxable benefit for the sum insured payable to that financial institution. If the proceeds, however, are paid to the deceased estate and then they are used to retire the debt, there may be no additional taxable benefit. So you contrast that again with the calling of the loan by the lender who uses its collateral assignment rights to collect the proceeds directly from the company, which could trigger a substantial extra benefit for the deceased estate. Again, talk to us more about how to set that up properly to make sure that you can actually avoid that. I now want to switch tracks and look at life insurance benefits paid by the corporation. The question that often comes up is a benefit going to be conferred as an employee or a shareholder when the life insurance benefits, the premiums, are in fact covered by the corporation? Well, there is a benefit that's being conferred. It could be conferred in the individual's capacity as an employee or in his or her capacity as a shareholder, as the owner, either the owner or the beneficiary, or the family perhaps is the beneficiary. The tax impact is comparatively easy to answer if the individual is not a shareholder. But what if the shareholder is also active in the business? And what if the benefits cover or are paid to a non-shareholder family member? So we have a corporate-owned policy on the life of a family member of the shareholder, or the policy is owned by the corporation, but the beneficiary is a family member of the shareholder whose life is being insured. If we're dealing with a non-shareholder key employee, and the policyholder or the beneficiary is an employee or related to the employee, then the premiums are taxable as an employee benefit under paragraph 6(1)(a) of the Income Tax Act of Canada, and the premiums may be tax deductible to the company. If we're dealing with a shareholder where the shareholder is insured, or a member of the shareholder's family is being insured, the company is paying for the premiums, perhaps they even own the policy, then the premiums are taxable as a shareholder benefit under subsection 15(1) of the Income Tax Act. And in those situations, if the benefits are deemed to have been conferred in that individual's capacity as a shareholder, the premiums are not tax deductible to the company. So it's really the worst case scenario, taxable to the shareholder, but not tax deductible as an expense to the company. So there may be an attempt made to make that deductible. How can you do that? You could gross up the premiums and report that as a bonus, and that could cover the income tax owed by the shareholder. Or you could have this all included in an employment agreement, and if it's included in an employment agreement and is deemed to be reasonable, then instead of being taxed as a shareholder benefit, it may be taxed as an employee benefit. Which brings me to the third scenario. A situation where the insured, the life insured, is a shareholder and employee of the plan, or related to that individual. It's a question of fact then whether the benefits being conferred are being conferred in that individual's capacity as a shareholder or as an employee. And so then you've got to look at the comparable benefits for other people in that organization or other people in similar types of organizations and structures. The premiums would be taxable as a shareholder benefit if they're deemed to be something over and above what would be reasonably paid to an employee, and as such, They would be taxable under subsection 15(1) of the Income Tax Act of Canada, and the premiums would not be tax deductible to the company. So taxable to the shareholder, not tax deductible to the company. If they're deemed to be conferred in that individual's capacity, who is both a shareholder and employee, but the benefit is deemed to have been conferred in that individual's capacity as an employee, then under paragraph 6(1) of the Income Tax Act, the premiums may be tax deductible to the company, although again, they are still taxable to the shareholder employee. Now, tax specialists frequently point out that the spouse, children, parents, or other related parties, or the estate of an insured shareholder should not be named as a beneficiary of a corporate-owned life insurance policy. If this is done anyway, then a taxable shareholder benefit will most likely be triggered. Let's look at ownership transfers from the corporation. And there are a number of reasons why and when a life insurance policy is transferred from the company to the individual life insured. Rationale might be that the insured shareholder is selling their business interest and they want that coverage for personal estate purposes. Or you're looking at a key employee that's leaving that firm for other employment, they're being terminated, or they are retiring. So what happens from a tax perspective when that transfer actually takes place? The Canada Revenue Agency considered it a question of fact whether or not a shareholder or employee is dealing with the corporation at arm's length. The finding determines whether the insurance policy being transferred would be considered a distribution from the corporation. The transfer may also trigger a taxable shareholder or employee benefits. When a corporation transfers an interest in an exempt life insurance policy, the income tax implication is the same as if it disposes of that interest. So there's a taxable disposition for the company where the cash value is greater than the adjusted cost basis. Then there's a taxable disposition consideration for the life insured where the consideration paid to now take on that policy is less than the fair market value of that policy. And for the life insured, as I've said in earlier slides, if that life insured is deemed to have received that policy in their capacity as a shareholder, the taxable benefit will be covered under subsection 15(1) of the Income Tax Act. And if the benefit that's being conferred or deemed to have been conferred is in their capacity as an employee, then the taxable benefit will be as covered under paragraph 6(1)(a) of the Income Tax Act, that being an employee benefit. But in either situation, the taxable benefit will be where the consideration paid for that policy, for acquiring that policy by the individual, the new owner, is less than the fair market value. Now, a person or a group of related persons who controls a corporation is deemed to be dealing in non-arm's length basis with that corporation. In other words, the two parties are related. And the same holds true for two corporations that are controlled by the same person or group of persons. The value of a life insurance policy is defined in subsection 148(9) of the Income Tax Act and is the amount that the policyholder of the policy would receive if the policy were surrendered. This generally means the cash surrender value of the policy, net of policy loans and unpaid premiums. The excess of the cash surrender value over the adjusted cost basis of the policy is a policy gain and will be taxed to the corporation in accordance with subsection 148(1) of the Income Tax Act and paragraph 56(1)(j) as income and as ordinary income, in fact, as passive income. The full amount is included in income since life insurance is not considered capital property by virtue of the definitions found in subsection 248(1) and section 39 and the description of the policy gain found in subsection 148(1) of the Income Tax Act of Canada. So again, what happens on transfer? The initial adjusted cost basis of the policy for the shareholder employee is equal to the proceeds of disposition. Usually it's the transfer price of the corporate-owned policy covered under subsection 148(7). Now, the purposes of the rules in that section of the Income Tax Act, or that subsection of the Income Tax Act, is to make sure that the calculation of the policy gain is based on the cash surrender value of the policy. What does that mean? It means that if the fair market value of the policy is lower than the cash surrender value, then the policy gain to the corporation is based on the higher cash surrender value as a minimum. On the other hand, if the fair market value of the policy is greater than the cash surrender value, then the policy gain is based on the cash surrender value, not the fair market value. Again, it's always based on the cash surrender value. And as I just pointed out, the transfer triggers a potential taxable benefit to the recipient, shareholder, or employee. So what factors are used to determine the valuation of a life insurance policy when a transfer actually takes place? The policy gain to the new owner is based on the fair market value minus the consideration paid. And that determines the taxable benefit to the shareholder employee. How is that fair market value determined? Well, again, we refer to Information Circular 89.3 entitled Policy Statement on Business Equity Valuations, paragraph 40 and 41, which goes through the description of the various factors that should be considered in valuing a life insurance policy and what the fair market value of that policy is actually going to be. This piece, entitled Life Insurance in the Corporation, reviews the tax implications on policy ownership changes and beneficiary structures. It also covers off how value of a life insurance policy is determined. It's available in the Advisor section of the Empire Life's website under Business Building and Newsletters. Please go to the Advisor section of the Business Building folder and refer to this newsletter for details on how to handle the accounting for corporate life insurance where the owner and beneficiary is the company. It's called Accounting for Corporate Life Insurance. This piece walks you through the details of how to track a corporately owned life insurance policy on the company's books, including premiums, cash surrender value, and the death benefits received. I frequently come across situations where the shareholder of a corporation wants to insure a relative, most often a parent or sometimes a spouse, who has no connection with the corporation. The main issue is whether or not the proposed owner of the life insurance policy, the corporation, has an insurable interest in the life insured, like a parent, who has no involvement or financial interest in the corporation, which is an important consideration at all times. The tax consequences of having a corporation pay for insurance on a family member with no connection to the business gives rise to a taxable benefit for the amount of the policy premium paid each year. The Canada Revenue Agency has access to several provisions of the Income Tax Act Canada to confer a benefit, including assessing a benefit as, 1, a shareholder benefit under subsection 15.1 of the Income Tax Act of Canada, a benefit conferred on a person under subsection 246.1 of the Income Tax Act of Canada, or a benefit under other subsections of the Income Tax Act. Another consideration is that shareholder benefits are not tax deductible to the corporation. Now, a common scheme is to have the company own and pay for a life insurance policy and have the benefits, paid out to an individual. They say, well, that's cheaper. That is cheaper than really having the individual pay for it or having the company declare an extra dividend or a bonus and pay that out to the individual and have the individual pay for their own policy. The scheme and the rationale is that the company is in a lower tax bracket and then would have more after-tax dollars to fund the cost of the insurance policy. But what is the real cost of the company to fund the insurance premiums if, in both situations, the company is the owner of the policy and is paying for everything, but the shareholder or the family member is the beneficiary, is going to benefit from that, or a scenario where the individual actually owns that policy and they're being paid an extra dividend, typically a dividend, to pay for it. What's the real cost of the company that leaves the individual who's going to get a taxable benefit in a net neutral position? So let's consider a scenario where we have a Canadian-controlled private corporation subject to the small business tax rate. The corporate small business tax rate is 14%. The personal taxable benefit tax rate is going to be one of two scenarios. In the first scenario, the individual is going to be in a 35% tax bracket. In the second scenario, the individual is going to be in a 50% tax bracket. And then correspondingly, in the first situation, when the individual is in the personal tax bracket, let's consider a situation where the personal non-eligible dividend tax rate is 25%, or in the second situation where the individual is in a high tax bracket, but not only are going to be in a 50% tax bracket, but the personal non-eligible dividend tax rate is 45%. Now, where do they come up with the 25 and 45% numbers? The non-eligible dividends includes a gross up of 16%, a federal tax credit of 10.03% as of 2018, and I'm using a provincial credit of 3.12% for Ontario. So there may be minor differences across provinces, but those are the assumptions I'm going to be using to really challenge the thinking about the real cost to the company to fund insurance premiums under these two scenarios. So under this particular scenario, in the following examples, the comparison aims to put the recipient of the benefit in a neutral position from a tax perspective, resulting in no out-of-pocket personal expenses. So there's no out-of-personal pocket expenses here. So in this scenario, this is a corporately owned policy. The individual could be the beneficiary of that policy, and the individual is in the mid-personal tax rate. We're going to assume that the insurance premium is $1,000. The pre-tax income required by the corporation to get $1,000 in that individual's hands is going to be $1,162.79. The corporation, of course, is going to be taxed at 14%, and then they pay out the $1,000. But that's going to be a taxable benefit to the shareholder of $1,000, on which that individual would pay $350 in income tax, which means they're going to be short. They're going to be short $650. So where are they going to come up with that money? Well, in order to come up with that difference, the corporate pre-tax income required to generate that additional dividend is going to be $542.64. The company, of course, would pay 14% tax on that, and then they would issue a dividend to the individual for $466.67. That dividend would fall into the individual's hands. That individual then would pay tax on that to the tune of $116.67. That would leave that individual with $350 left over, and that would represent a shortfall from the initial $1,000. And now they'd have enough money there to pay for to cover the tax and all those premiums. The total pre-tax income required in that scenario under that particular type of a strategy is $1,705.43. Now let's compare that to a scenario where the individual owns the policy. The individual is in the mid-personal tax bracket, owns that policy, and the company is simply going to pay out dividends to that individual, taxable dividends nevertheless, dividends to that individual so the individual can buy and own their individual life insurance policy. To begin with, the additional dividend required to pay out $1,000 net would be $1,333. The tax and dividend would be $333.33, and that would leave the individual with $1,000 to pay for the premium without having to reach into his $1,333 to pay to the individual. What does the company have to own, and what do they have to earn? Well, the company would have to have earned $1,550.39. They would pay tax at a rate of corporate tax rate of 14% of $217.05. That would leave the corporation with net income of $1,333.33. They'd issue that as a taxable dividend to the individual. The individual, of course, would pay the $333.33 in income taxes. That would be their taxable benefit, and $1,000 would still be there to pay for the premium for the life insurance policy. All in, it would cost the company $1,550.39. So as you can see, when the corporation owns a policy, and you compare that to the individual owns a policy, typically it is cheaper to simply have the individual own and pay for that life insurance policy via an extra dividend. The cost difference here, you see a difference between $1,550 doing it that way, having it personally owned with the individual in a medium-sized personal tax bracket, as opposed to having the company own the whole thing and simply apply taxable benefits for all the premiums being paid on that policy. Okay, we're dealing with a middle income tax bracket. Now what happens though if we're dealing with a situation where the corporation decides to own that policy and the individual is in a high personal tax bracket? Let's compare that type of a scenario to one where the corporation simply decides to pay out an extra dividend to this high tax bracket individual, and the individual simply owns and pays for the insurance personally. Again, we're looking at $1,000 of premium that has to be paid for by the policy, or for each $1,000 of premium owed to cover the policy costs. The pre-tax income required, again, $1,162.79. There'd be corporate tax of $162.79. That hasn't changed from the first scenario, but that would kick out $1,000 in dividends that we paid out to the individual. But again, remember that the individual now is in a is in a high tax bracket of that. So the taxable benefit on $1,000 is going to be $500. So the individual now only has $500 left. He said, well, I got to pay for this premium. That means I got to reach into my pocket for the difference to come up with that $500. But again, we want to keep the individual in a neutral position. No out-of-pocket personal expenses here to cover even the taxes. So there's an additional dividend that's going to be required of $909.09. The tax net dividend will be $409.09. That will leave a net amount to the individual of $500. That will cover off the first $500 of the taxable benefit. Now there's $1,000 left to pay for the premium so that the individual doesn't have to reach in their pocket. Again, in this scenario, the company's paying for everything, but they're simply applying taxable benefits for all those premiums paid. But what does the company have to earn? We know in that first $1,000 that they actually issued, they had to earn $1,162.79. But now they've got to add an additional dividend to cover the tax that's going to be assumed by the individual. The individual actually has to pay. So to generate that additional dividend, the company would need to earn an additional $1,057.08, on which the corporation would pay $147.99. That would trigger a taxable dividend to the individual of $909.09. That goes to the individual. The individual, of course, pays $409 in tax net money, leaving that individual with that additional $500. Now they've got the $1,000 is there to pay for the premiums, no out-of-pocket personal expenses. What does that cost the company? Well, in total pre-tax income, it cost the company $2,219.87. So $2,220 essentially to fund it that way, corporate-owned policy. What would happen if the policy was simply owned by an individual and the individual is in a high marginal tax rate? Well, in that type of situation, in order for the individual who's going to get have to pay tax on this money to have $1,000 left over after tax, the company would need to issue a dividend for $1,818.18. The tax net dividend would be $818.18, and the individual would be left with $1,000. Now, what does the corporation have to earn in order to come up with that $1,818.18 in taxable dividends in the individual? The company would need to earn $2,114.16. The company is in a 14% tax bracket. The company would pay $295.98 in income taxes, leaving the company with $1,818.18 after tax. They would pay that out as a taxable dividend to the individual. The individual would pay $818 in income taxes with $1,000 left over and pay the premium. But the total there is $2,114.16. Again, compare that to what would happen if the company was paying for everything directly, corporate-owned policy. The company would need to generate, and really, in order to keep the individual in a neutral position, again, $2,220. Again, more expensive than it is, even though it's marginally more expensive, it doesn't make sense. Now, each jurisdiction will come up with slightly different numbers. You may find a scenario where it actually does work, but the marginal differences are going to be very, very minor. And you have all this complexity about what will happen sometime down the road where the individual says, that corporate-owned policy, I want you to transfer it to me. There's no further need for it in the corporation, or I'm leaving the corporation, or I'm going to sell the company, whatever. I now want to use this for personal tax estate planning purposes. And now you're going to be dealing with all the issues I covered off in earlier slides. This is much neater, and in most cases, it's less expensive. Now, though you may think at first that a corporate-owned life insurance policy, again, is more cost-effective using corporate dollars versus a personally owned policy, it is important to review the alternative tax consequences and consider all the variables on a case-by-case basis. Hopefully, this explanation has helped you out, and of course, you can certainly contact our tax estate planning team to help you determine the most cost-effective ownership structure to meet the needs of any particular situation. Let's consider what happens on the death of a shareholder. Up until the July 2017 tax proposals, there used to be two well-used strategies designed to address double taxation when a shareholder of a private corporation passed away. For more information on this, please attend our taped webinar on the federal budget and Canadian-controlled private corporations, where I review each one and then consider the issues with the new proposals and the new legislation. Let's spend a little time on issues and considerations that need to be taken into account and acted upon when there's a graying of the current purpose of corporate-owned life insurance. Through some case studies, we will look at how corporate-owned life insurance may conflict or support personal estate needs and obligations. A startup business frequently requires money to get ideas implemented, business plans executed, and day-to-day expenses covered. It seeks out a lender. The lender may be comfortable with providing a loan as long as the key people in the business are around to run and build the business. What happens if a key person passes away? Business operations may suffer or may no longer remain viable. The lender may want the debt required, yet there may be no liquid funds to make that happen. So professional advisors often recommend life insurance covering the key person as a way of satisfying any lender concerns and repaying out loans. And in some situations, the key person may not be an owner. In other situations, the key person and the owner are one and the same individual. The insurance policy in either scenario is owned by the business with the company or lender named as beneficiary of the policy, or the policy is held as collateral against any outstanding amount at death. What happens when the initial need for the life insurance changes? What if the policy is now needed for personal estate planning purposes? The policy may be treated as if it were part of a personal estate plan, even if the corporation is the owner of the policy, with benefits to be paid out to individuals, not the company. The scenarios I talked about earlier, even though the company still owns and pays for the coverage. If claims against the personal estate crop up, who has rights to the policy proceeds? Let's look at the Goodis estate. The Goodis estate was a state in Ontario, a case in Ontario, where two life insurance policies were issued by London Life in the amount of $750,000 each on the life of Gerald Goodis. The policies were owned and funded by a holding company. The holding company was jointly owned by Gerald and his second wife, Lynn. Its main purpose was to lend money to finance an operating company run and owned by Gerald. Lynn had loaned the holding company approximately $1.8 million. One of the prime purposes of the life insurance was to cover the loans. A second purpose was to fund a buy-sell agreement between Lynn and Gerald. So two identical policies were also issued on the life of Lynn Goodis, again owned by the holding company. The operating company paid the premiums on the policies until it became insolvent. Then the holding company paid the premiums. The holding company changed the beneficiary on both policies covering Gerald to Lynn Goodis personally in 1995. The holding company changed the beneficiary on one of those policies 4 years later to provide $25,000 each to Gerald's two minor sons from a previous marriage, with the balance still going to Lynn. Gerald had been providing court support and court-ordered support for his two sons, and the beneficiary on the policies on Lynn's life were changed to Gerald Goodis. So this was a crisscross type of relationship where Gerald's policies were now, the beneficiary of that was now Lynn, and the beneficiary of Lynn's policies were now Gerald, where they originally had been the corporation. Gerald died suddenly in 2000. He was essentially insolvent. The guardian for the two sons sought support, claiming that the two corporately owned life insurance policies covering Gerald were effectively part of Gerald's estate. So this was over and above the $25,000 each the two sons were going to get. Lynn Goodis claimed that she was entitled to proceeds as designated in the two policies because she was the beneficiary. So the matter went to court for a decision, and the key question was, who effectively owned the two life insurance policies? What claims do families have to those life insurance proceeds when seeking support from the estate? Gerald's first wife initiated a court action against Gerald's estate on behalf of her two sons for child support and an order declaring that the two life insurance policies on Gerald's life form part of his estate for purposes of the Succession Law Reform Act, specifically subsection 72(1)(f), which states, any amount payable under policies of insurance affected in the life of the deceased and owned by him or her. The court was asked to rule on whether the corporate-owned policies covering Gerald could be deemed to be effectively owned by Gerald before his death. The policies on Gerald and Lynn Goodis were never referred to as assets in the holding company's financial statements, so that would support the first wife's claim. There was no buy-sell agreement that was ever completed between the two equal shareholders, Gerald and Lynn Goodis. Both the holding company and the operating company were essentially inactive by the mid-1990s when the beneficiary designations were changed to individuals instead of the holding company. Now, this was done on the advice of the accountant and the insurance agent. Further beneficiary changes were made in 1999, which included naming Gerald's children from both marriages as beneficiaries. And this, again, was done on the advice given to Lynn by a lawyer as part of some estate planning. So other professionals weighed in on the situation and on the structure. Lynn, furthermore, had been repaid over $1.1 million of the $1.8 million loan to the company. She did not feel that she would ever get the balance back since the operating company was no longer active, and she and Gerald felt that the amounts left to the two boys should cover any support obligations remaining on Gerald's death. The Ontario Superior Court declared that the two insurance policies on Gerald's life formed part of his estate. It ruled that the meaning of the word owned should be given an elastic and purposive meaning. Gerald Goodis had a beneficial interest in the two policies on his life. He exercised some control over them for personal needs and was no longer using them for corporate purposes. The two policies on Gerald's life were to be included in his estate for purposes of the Succession Law Reform Act. Well, Lynn appealed that decision, and the Ontario Divisional Court allowed an appeal. It ruled that the policies in questions were owned by the holding company, which in point of fact they were. Gerald was not a sole shareholder of that company who could use the company for personal estate planning. He owned 50% of the shares. The determination that Gerald owned the policies ignored the interests of both the holding company and the other 50% shareholder, Lynn, who was Gerald's second wife and also the part owner of the business. The premiums were paid at all times by the holding company. One of the prime purposes of the insurance was to provide security for the money still owed to Lynn. So the insurance proceeds were not to be considered to be part of Gerald's estate under subsection 72(1)(f) of the Act, and the benefits were paid out as per the instructions and directions given to them by the professional advisors. Life insurance is frequently bought by insurance owners and business owners through their corporations, with the corporation named as both owner and beneficiary. Sometimes the rationale is readily apparent and documented, like funding a share purchase agreement, or providing coverage against the untimely passing of a key employee, or, as I talked about earlier in the session, as required collateral coverage against a bank loan. At other times, the purpose may not be as apparent, such as providing extra liquidity at the time of death of the insured owner, or providing cash to pay for capital gains taxes, or indirectly to provide benefits for family members. So what happens when a company is sold? Who then owns the policy and becomes beneficiary? Well, in the absence of clear documentation, disputes can arise. Let's consider the case of Newport versus Mountainside Medical Pharmacy Limited, a case settled back in 1999. The deceased had arranged for a life insurance policy on his life owned by his company, which was also named the beneficiary. So the company was owner and beneficiary of a life insurance policy on the life of the deceased, who, of course, was the owner. The owner contracted AIDS, he became ill, and sold his business 2 months before committing suicide. He and his wife had been separated, but although they were separated, he had continued to provide for both her and their children. The wife had been named in his will as both executor and sole beneficiary of his estate. She had also remained as beneficiary of a number of life insurance policies on the life of her late husband. The new owners of the pharmacy took the position that the life insurance proceeds were an asset of the business. The wife provided evidence suggesting that the deceased did not consider the life insurance policy to be an asset of the business he had sold, and had not intended to have it sold as part of the deal. The purchasers admitted that they never intended to buy the policy, nor did they pay anything for that. That said, the new owners of the business relied on the provisions of the Insurance Act, including the absence of a declaration changing the ownership and or the beneficiary. Needless to say, this case went to court. The wife went to court. And the court considered the essence of the share purchase agreement for the pharmacy and the way the policy was being dealt with by the deceased while he owned the company. These two factors indicated that the life insurance policy was held for the benefit of the deceased's wife and children and was not an asset of the company. The court sided with the deceased's wife, ordering that the life insurance policy be retroactively transferred from the business to the deceased and changed the beneficiary designation to the wife. Wow. Courts have suggested that this is an extreme case, yet it has been referenced in a number of other cases. This certainly points out to the importance of clarifying intent of a policy, not only when purchased, but when it knowingly or usually is inadvertently sold in a share purchase of a business. We should cover off what happens to life insurance policies owned by a corporation. Additionally, concrete steps should be taken to move policies from a company to the individual life insured when the purpose of the policy is now to fund personal estate planning wishes. Watch again for deemed dispositions of the policy for income tax purposes and potential taxable benefits to the new individual owner. I developed several pieces on what happens with corporate-owned life insurance and personal estate planning or estate challenges. Please connect with me on LinkedIn and peruse the newsletter section in the business building part of Empire's website for articles on corporate-owned life insurance, the actual versus effective owner of a corporate-owned policy, the corporate-owned life insurance and what happens with dependent relief claims, the insured buy-sell agreements and the capital dividend account, and an article on corporate-owned life insurance and death after a share sale. This piece, entitled Insured Shareholder Agreements and the Capital Dividend Account, features a case study and a court decision dealing with who gets to benefit from the capital dividend account when a company receives life insurance proceeds that are earmarked to buy shares. The Conference for Advanced Life Underwriting has sought specific exemption for life insurance given the 5 years of negotiations which culminated in revised rules affecting corporately owned life insurance and credits to the capital dividend account, which took effect in January of 2017. And again, barring some aggressive investment-focused applications of life insurance owned by a corporation should not be subject to any more income tax rulings and challenges by the Canada Revenue Agency. Keep in mind that distributions of taxable dividends to family members funded by life insurance may be affected by the new rules on split income, and distributions of life insurance proceeds from policy dispositions may be caught by passive investment rules. Again, when you look at life insurance as a tax-exempt treatment, exercise caution here. We've got a lot of rules here, and I do hear advisors and specialists from other companies touting the fact that this is the last bastion for tax sheltering. This is the #1 way we can avoid all the income tax rules. Take real caution. Actively promoting cash value life insurance as the answer to corporate passive investing is going to attract unnecessary attention by the Canada Revenue Agency. There are proposed rules that are already in place and already have an issue with cash value payouts, as I just mentioned. They could be deemed to be ineligible for the refundable dividend tax, and it wouldn't take a lot to tweak the current income tax rules to catch this type of a scheme, to catch all of this under passive investments. And in fact, with a death benefit, it may not even be a credit to the capital dividend account, and we certainly do not want that to happen. We need to stay focused on the life insurance need as the primary driver for the strategy. Be prepared to defend why the structure is set up that way in terms of ownership, life insured, beneficiary, payor, type of insurance used, and of course the strategy. What is the purpose for the insurance and the prime purpose for the insurance? Stay focused on the insurance need. Again, challenges may bring opportunities. So what are legitimate uses for life insurance? What are strategies that can color a cloud or make a position defensible when you're looking at corporate-owned life insurance, particularly cash value life insurance, inside a corporation? Well, if it's being used to deal with higher taxes at death, a legitimate reason for owning the life insurance in the corporation. To preserve the corporate asset value for beneficiaries. To pay for capital gains ineligible for lifetime exemption. To fund the wind-up of a business, the sale of a business, to replace funds used for survivor benefits now and loss of taxes as a more cost-effective, perhaps a less expensive way of paying for long-term insurance that perhaps is needed on a permanent basis, and to support an insured retirement plan strategy. Again, for insurance-based investments are in the same boat as other types of investments, so we need to promote the distinguishing features and benefits of insurance-based investments and recognize that these types of contracts can be used as funding vehicles when an individual wants to take surplus or profits to fund individual pension plans, retirement compensation arrangements, or other group benefits. I trust that this session fleshes out the series on running a small business, including the impact so far of the federal proposals and legislation on Canadian-controlled private corporations, the small businesses with whom you deal, and the businesses you run yourself in servicing them. Be sure to participate in all 3 sessions and the update on federal proposals and legislation, all available via taped webinars hosted by Empire Life.